My name is Faye Howard and I'm a private client tax director at our Ipswich office. Now I have to confess, I was slightly worried yesterday when listening to the budget that I might not actually have an awful lot to talk to you about this morning. I thought for a moment I might have to sing you a song, but actually you'll be very pleased to know that we did find something to talk about, and where I'm going to start is with tax rates and allowances. Not terribly interesting, so I'm not going to spend too much time on it, but the personal allowance has essentially increased from £11,500 to £11,850 for the 18-19 tax year. We've also seen an increase to the basic rate tax band from £33,500 to £34,500. Changes to dividend income. This wasn't actually announced yesterday, but we knew it was on the cards because it had been announced previously. The dividend allowance, of course, is the amount at which you can receive in dividend income on which you pay no tax. This allowance was introduced in 2016-17 at £5,000. It's still currently in place at the same level. From the 6th of April 2018, it reduces to just £2,000. What does this mean in practice? Well, actually, it's not huge changes. The people who are going to be most affected by this are those with dividends at the lower end of the scale. And the reason for this is because when you get into dividends into the higher rate tax bands, the increase in the basic rate band has absorbed some of that impact. That slide just illustrates that point. Changes to personal tax were few and far between, but we do have a small change to the marriage allowance. Now, the marriage allowance is a not terribly widespread allowance, but what it is that it allows the transfer of up to 10% of the personal allowance between spouses or civil partners. So if you have spouses where one isn't working, has unused personal allowance, and the other's a basic rate taxpayer, the one who doesn't pay tax can transfer up to 10% of the personal allowance to the 20% taxpayer, and that's worth £230 currently in this tax year. This has been tweaked ever so slightly so that now we can make a claim in respect of a deceased taxpayer, and that claim can be backdated by up to 4 years. Whether that will increase use of this allowance, we don't know, but it's suck it and see. Property income. I had to talk about property income. This time last year, I think it was, I wrote an article for Essential Suffolk magazine. And because it was Christmas, I did it in a form of my Christmas wish list to the Chancellor. And one of the things that I asked for in that wish list was something for residential landlords, because frankly, the Chancellor's been pretty mean to any residential landlords out there with the increase in stamp duty land tax for second and subsequent properties and the changes to the way that tax relief is given on mortgage interest, which I'll talk about in just a second. There was a very, very small giveaway in the budget for landlords with an unincorporated property business. And it just comes in the form that now, if you have motoring expenses connected with that business, you can claim mileage allowance instead of claiming a portion of the cost of your motoring expenses that relate to the business. And to be honest, that's what people were pretty much doing anyway, but there you have it. You're welcome. Further changes to property taxes, rent-to-in relief. The government have made calls for evidence to make sure that rent-to-in relief is operating as they expected it to. Now, if they've given a call for evidence to make sure it's operating that way, I think there's a fairly strong suggestion that it probably isn't. Rent-to-in relief, of course, was increased quite significantly for the 16-17 tax year. Previously, it was at £4,250 per annum, and that was increased to £7,500 for the 16-17 tax year and for the current tax year. So we'll have to wait and see whether there will be any changes to that at all. Got to talk about changes to the way tax relief is given on mortgage interest. These changes were introduced in the summer 2015 budget, and essentially what they mean is that landlords with mortgages on their properties are going to see a significant reduction in the amount of tax relief that they receive. These changes are being phased in over a 4-year period, and I've just got a slide here that illustrates them. This is something we've talked to our clients and professionals about an awful lot because these are quite significant changes. The example I've got here is based on a rental property with a 5% rental yield, 70% loan-to-value mortgage, and mortgage interest is charged at 4.5%. So if you look at those numbers, you'll see that actually the actual profit that's made doesn't change in any of those 5 years. but the amount on which tax is paid changes quite significantly, and that flows through to the amount of tax that's paid at the bottom. You'll see there the total tax due on the same profit for 16-17 is £2,220, but that increases to £4,110 by the time we get to the 2020-21 tax year. That's an increase of 85%. And actually 2017-18 is the first year that these changes will start to bite. So when we come around to doing the 2018 tax returns, that's when landlords are first going to start feeling the effects of these changes. We knew that there were going to be some national insurance changes. Class 2 national insurance was scheduled to be abolished from the 2019 tax year, but actually this is going to be delayed by 1 year. It's now going to take effect from April 19. We're also going to see some reforms to termination payments. What this will mean essentially is that more termination payments, payments in lieu of notice, will be brought within the charge to national insurance. And there's also going to be some national insurance changes to sporting testimonials, but that's quite niche, so we won't spend time on that this morning. Capital gains tax. It doesn't really seem that long ago that I was standing up here talking about reduction in capital gains tax rates. Now, nothing actually changed rates-wise in the budget, but what has changed is a couple of points. We were expecting an acceleration at the date at which capital gains tax will be payable on disposals of residential property. We were expecting that to come in from April 2019, and the change is essentially that CGT would have to be paid within 30 days of the sale, where the individual making the disposal isn't within the self-assessment system. That also has been delayed by a year and pushed back to April 2020. There's also proposals to extend UK capital gains tax to non-residents that have UK non-residential property. Currently, it's only non-residents that have UK residential property that fall within that charge, but essentially these changes will bring commercial property within the charge to UK capital gains tax too for non-residents. Tax-efficient investments. This is one of my favourite subjects. Grant, I know, is going to talk about this in just a moment too from the investment side, but I just wanted to mention the tax reliefs. We have Enterprise Investment Scheme, EIS, SEIS, which is Seed Enterprise Investment Scheme, and Venture Capital Trust, VCTs. Haven't got time to talk about them all this morning, but I did just want to talk about EIS because we have seen some fairly significant changes to EIS. The first of these changes is a doubling of the annual limit which can be invested into an EIS company. Previously it was £1 million, now increased to £2 million, but at least £1 million of that has to be in knowledge-intensive companies. And Grant is going to talk to you about how the underlying investments behind these products is going to change as a result of the budget. Now, when Grant and the other IFAs talk about EIS investments, they always have to refer to them as a higher risk product. And I think that's fair enough. However, it's a really important point to make that actually a lot of the risk in these investments is underwritten with income tax relief. So if, for example, you're a 40% taxpayer and you make an investment of £100,000 into an EIS, you'll get £30,000 of income tax relief on that investment. If that investment all goes horribly wrong, you've got a £100,000 capital loss. Now, if you had something like shares in BHS, when that went under, you've got a capital loss. Well, what can you do with it? Not an awful lot. You can claim it against capital gains in the current year or subsequent years, but that's pretty much it. If, however, you have a loss on EIS shares, you can claim that loss against income. And because typically we pay income tax at significantly higher rates than capital gains tax, there's a benefit in doing so. So the effect of this income tax relief against a capital loss is that actually, of that £100,000, £58,000 of it is underwritten with income tax relief. That's for a 40% taxpayer, 58%. That increases to 61.5% for a 45% taxpayer. So just do keep that in mind when Grant's talking about changes to EIS investments. Final thing I've got to talk to you about this morning is trusts. We heard in the budget that there's going to be a consultation in 2018 on how to make trusts simpler, fairer, and more transparent. Well, what does that tell us? Apart from the fact that HMRC is terrible at grammar, it tells us that in all likelihood, they're going to get more complicated, less fair, and probably more opaque. But we'll hope that actually they will do something about this, because trusts are very important, but they are quite difficult to understand for a lot of people. So hopefully this will be a positive thing. In the meantime, however, HMRC has a shiny new trust registration service. And as a result of the introduction of this service, all trusts that had a tax consequence in the 2016-17 tax year will have to register with this service either by the 5th of January 2018 or the 31st of January 2018. Which of those two dates is dependent on whether or not the trust is currently registered for self-assessment. In addition to this, and as a separate registration, trusts will also be required to register with the London Stock Exchange for a legal entity identifier, or LEI, if they have or wish to hold in future traded investments, things such as stocks and shares. If they don't have an LEI, they simply won't be able to trade traded investments. So a big change for trusts.